ready? We're going to bunch of earnings reports hitting. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Here's the position disclosure. I just forgot to add that I did keep T-Triple-Q short. Everything else is the exact same. So now it's on there. It's updated. So kept some T-Triple-Q shorts and update. Everything is the same from yesterday. All right, let's take a look at some markets. Take a look at some of these earnings names that are coming out. So we got some interesting names that are all over the place. First, look at the trade desk. If we can find the numbers. This is one of my favorite companies. I love their business model. I think they've done such an incredible job kind of cornering parts of the advertising market. TTD beats on EPS, misses on revenue, guides light, but approves it's an odd number, $564 million buyback. So it looks like they're hitting down on the guidance. Buyback's got to help a little bit. Really good company. Maybe got ahead of itself with this move. This is one that I'm going to keep on the radar at a certain point to buy for sure. But like that buyback, but of course missing on revenue guidance is never great. We've got Cisco out. Cisco crushing. Cisco revenue guidance for the fiscal year is a real nice beat. Real nice beat. So Cisco trading its way up after hours. It's an important. It's a slow mover. I don't trade it very much, but 6% move after hours is pretty decent. And this stock's trading really well. Look at this uptrend. It's been in a while. For a while. Cisco really nice. We got Robinhood out. Robinhood also pretty decent upside move here. It pulled back off highs. It's up 10% after hours right now. Robinhood beats on fourth quarter net revenue, beats on transaction revenue. How did they beat on transaction revenue? I thought they didn't charge commissions. Fourth quarter crypto revenue is a really nice beat. Fourth quarter assets under custody is a nice beat. Not providing a 2025 outlook for operating expenses. I never loved that headline. But bottom line is without seeing any guidance in Robinhood, those numbers look really nice. What else we got on here? Fastly trading up. Or is it? Yeah, hard to tell. Widespread there. There doesn't look as much action going on in Fastly for the moment. Here's an important one. Reddit trading down. So we got TTD and Reddit trading down. Those are pretty important companies. We got Cisco and Robinhood trading up. Those are also important companies. Reddit and TTD obviously more representative of the advertising space. Reddit sees first quarter revenue ahead of expectations. That's not bad. Yeah, so they guided the revenue well. This is probably hurting it. Daily active users is down. So if anything, that's not necessarily a bad read-through on advertising though, because if their daily active users are down last quarter versus expectations, but they're able to guide revenue up, that's actually not that bad. Sees first quarter adjusted EBITDA, that's a beat. 80 to 90 million versus 72.3 million. Yeah, these numbers don't look bad to me. I assume that they're just hitting this Reddit down. One, because that huge move into it, and two is because they did miss on their daily active users. I like this company a lot. I haven't been involved in it in several months. Did really well with it immediately after the IPO. But I just think this company has so many different levers it can pull still from a revenue perspective that are only in the infancy stages right now. So I like Reddit on big dips, broadly speaking, but we'll keep an eye on this. Both Trade Desk and Reddit, I think, are good companies to buy big picture on good dips if we can get the right signal for them. But maybe they each got a little bit ahead of themselves coming into the report. We got App 11, also crushing. Whatever this company is, I don't know. They continue to crush. There's an echo on the YouTube. Thank you. I probably just fixed it. I usually have to make one quick adjustment before I start each meeting. Yeah, App 11 absolutely crushing it. Okay. Sorry about that with YouTube. I probably fixed it. If you can let me know if it's fixed or not, that would be appreciated. It's so weird. The one thing I have to do before every afternoon meeting to stream on YouTube properly is to pull my headphones out of the jack. If I do that, it's great. If I leave it in, there's an echo. How weird is that? Anyway. Let's talk about the market today. Holy cow, what a day. So SPYs finished down 0.3%. Qs finished up 0.15%. The IWM finished down a full percentage point. So Russell took a little bit of a hit, but closed well off of its lows. It's a separate microphone that I use. TLT smoked, interest rates through the roof. The dollar up small. I mean, this is crazy to me. This market's really nuts. So, interest rates are getting jacked through the roof again. CPI came in super hot. That core month over month, I think, was like 0.45% or so. I don't remember what the expectations were, but the expectations were a good bit below that. And at that rate, that core month over month number, the projections that we had seen come from two different resources, JP Morgan and Goldman Sachs, both more or less estimated that this CPI that we got today should lead to a down move in the S&P of at least 1.5%. A down move in the S&P of at least 1.5%. We basically finished flat. SPYs finished down 0.3%. Pat giving me the number, the same core month over month at 0.4% versus expectations of 0.3%. I thought it might have been 0.45. But still, still hot. Number came in hot, and the market recovered all the way back up. I mean, holy cow! Let's look at this pre-market price action in conjunction with the open. This market's just unstoppable. We technically never broke the 8:30 a.m. high for the SPYs. We do it for the Qs. Ooh, we got right to it. We technically never fully recovered that, which always is important. I always say you need to actually negate the 8:30 high in order for the market to turn bullish on the small time frame. We didn't actually do that, but the degree of the recovery, as far as I'm concerned, is incredible. They destroyed this market on that number. I think appropriately so. And we put in a low at 905 of 598 spot 23. And then look at this market when we actually opened at 930. Like a very, very quick little downtick fluctuation. We had a really nice bounce back to the ADMA. It was a beautiful price correction. There was no time correction of that gap at all. The buyers came in immediately. We had a really good team call out to short the market on the first test of the ADMA on the 5 minute. To me, this just seems super bearish. I really had my bear hat on off this number, and we'll circle back to the big picture context in a second, but let's just stick with the small time frame. So that number made me have my bear hat on, but we don't chase downside opening and extension on big gaps, right? I mean, you can if you're looking for, like, if you're a pure momentum scalper, but that's not really my game. I look for more reward than that. So in order to really execute soundly, I wanted to see the technical equilibrium on the market catch up to price, or price catch up to that equilibrium to create a pivot. So we had a great call out on basically this first touch of the ADMA here for the SPYs and for the Qs as a short. And honestly, when we pulled down here, I was like, oh, we got this. And it was a big enough of a move to obviously make money versus where we called it out, which we called it out pretty perfectly at this pivot high. And then I remember at this low, I was saying, hey, I don't think we're going to immediately make new lows on this market. I'd be surprised. I expect that if we're going to work our way lower, that we actually will attempt to make a higher low, but then another lower high. What is that? That's a wedge, right? So that'd be the beginning of a wedge, because at this point now it's 10-10, ton of extension on the 15-minute chart still, and honestly, this pivot high to move lower, I just got the Qs up right now, was like a $3 down move. That's a big move in a short period of time. We're not only at 10-10 are we again extended on the 15, but we're actually extended on the 5 again because that move was so quick. So it makes sense for bulls to come in and attempt to defend things here. And really, I think that the best bear scenario would be to build out that wedge pattern, let the ADMA on the 15 or the 21 EMA on the 5 catch up to that price action a bit, and then we could break lower and make new lows, maybe as we approach like 11 a.m. or so. And then the snapback, though, off of this higher low was incredibly strong. I mean, the dip buyers are just in full force. We shot this market up here incredibly well. I remember I tried to short the Qs again around this high. This is like, wow, we really did like a big 15-minute correction here. That's the high of this 15-minute bar. Let's see if I can get some sort of a pullback as we get into this 15-minute equilibrium. Now, given the time of day, again, given the bearish sounding CPI that we got this morning, and we rested for 10 minutes. We built like a bull wedge on the 5-minute or a bullish shooter on the 5-minute that then broke up again before we got a bit sloppy. This is why at this time of the day, 15-minute charts are so important. We made another higher low on the 15-minute, another higher high on the 15-minute. Kind of one last chance into this gap fill. Actually, I think I shorted here and made a bit of money on it. But then another chance I took into this gap fill here. Like, wow, this is incredible. I can't believe that we're here. But Qs are showing relative strength. IWM's not really doing it. I think that I potentially could. They just overshot this and pushed everybody out. We can look for the short again. And obviously that was just very difficult, and the market at that point just got super boring again. Super boring. The last couple days have been really boring. Today shouldn't have been so boring, and it wasn't in the beginning of the day. With the afternoon session, look at the Qs, look at the SPYs, it actually got really boring and really sideways again, and this like intraday volatility kind of slowed down. So the bottom line is that the dip buyers are still there. Obviously, this market is incredible with how well they are continuing to defend the market. So now that we kind of analyzed what this price action was on the 5-minute, and it really defied my expectations, and obviously to some degree defied what Goldman Sachs and JP Morgan analysts were expecting off of a number that came in a bit hot. Let's turn this over to the daily chart. And it's been so incredible. This is the third event in 3 weeks that is a bearish event that basically caused a big gap down that was completely bought back up. DeepSeek was the first week, then the tariff scare was the second week, and now this hot CPI is the third week. It's incredible to me how well these buyers have continued to come in. And there's definitely a technical school of thought. If anybody watched me with Greta and not Greta, Sammy and JR and Michael Comeau today, Sammy views this as technically bullish, and he's definitely not wrong. And it's something that we should be considering. That, wow, every time these buyers, these dip come in, those buyers are there. They're so strong. This is technically bullish. We're still in an uptrend. We're building out, you could argue, a really big picture kind of bull wedge here. This 21 EMA, 200 EMA, 200 simple moving average is slowly catching up to the pivot low that we had in January. that's all technically bullish. My thought process is still on the other side of that coin. Um, we knew and expected that there's really strong underlying buying to this market, right? We know that. And we know that from a seasonality perspective, we've seen the data, we've seen the charts. We know that the systematics have been buying. We know retail has been buying hand over foot, and I'm pretty sure we're going to see that retail was the big buyer again today. Um, uh, you've got a positive gamma environment, but not massively positive from what I had seen. And bottom line is that there's still just a lot of money flowing into the market that always tends to happen in January through mid-February, and that buy flow, that money flow is particularly large after a bullish year as well. So last year was a really bullish year, obviously. This underlying bit to the market just continues. But I'm asking myself more of like, well, to me, every time we get this dip down that gets bought, these like 1 to 3% dips that are immediately getting aggressively bought, I just feel like that is those buyers using up their bullets, and eventually they're going to run out of those bullets if we don't get a breakout to all-time highs. If we get a breakout to all-time highs, then especially if we break out and hold, then I think you got to take your short thesis and completely sideline it. Stop yourself out of those shorts, buy the breakout, see what sort of follow through you can get on the upside. But if we can't actually break out to those new all-time highs, how many more times are these dip buyers going to be able to come in and do this aggressively at a 1 to 3% pullback? How much buying do they have? I think it's going to run out, and once we get into this mid-February area, I don't have a specific like day to point to, or I could say February 18th is that day, but the same information that we've seen that shows just the huge amount of forced money flow into the market that is in January through the first half of February actually reverses in the second half of February. So you actually begin to see outflows. And I think that those outflows can last really through tax season, especially. Taxes are due obviously April 15th. Money outflows kind of begin to happen in the second half of February. People made a lot of money trading. I remember when we were trading December, we were trying to look for some like Santa Claus rally, tax loss harvesting type of trades. And I remember us talking about how few there were. There were not many places to be able to come in and do your tax loss harvesting for 2024, because everything for the most part had performed so well. There definitely was some, you definitely could find them. I would argue like BYON was one of those. But a lot of people made a lot of money last year, and they're gonna have to pay the tax man on that. And so I think that means that we begin to see outflows start in mid-February. That's what the data shows. I think that can last through mid-April, and I think when that happens, then this dynamic that we've seen is no longer able to occur. The question becomes, though, can we get another catalyst? Because I do think that you always need a catalyst to trigger things. And we've had several potential catalysts that have led to nothing now. But that's because they've been into this forced buy flow. And the flip side of the coin is I almost wonder if we didn't have these 3 sell catalysts 3 weeks in a row, where would this market be? With all that same forced buying that was potentially coming in, would we just be at like SPY like 620 by now? I don't know the answer to that question. Obviously, I don't think anybody does. But it's incredible to me how well they've continued to buy this up. I still maintain a bearish thesis, but it needs to be confirmed by the technicals. And it's the biggest thing that I've been trying to emphasize is we know that there's a really strong buy flow that's out there. We know that leads to seasonal weakness starting in mid to late February. if you're trying to be short this market and you don't have the technical confirmation, because you definitely don't have the technical confirmation, pretty much all support levels are being held, even if we haven't been able to break through resistance levels, then you have to be patient and actually wait for the execution of that trade to come in. I could speak for myself that I have certainly been jumping the gun a little bit because I've got just this thought process and I've been trying to push the short side a little bit and haven't had that much success with it. On an intraday basis, I've actually done pretty well, as long as it seems like for a while, almost every day, I was shorting the Qs, but closing them by the end of the day. And the next day, I would short the Qs and close them by the end of the day. And I was actually making money every single day doing that until today. Today, I probably jumped the gun a little bit because I thought that this hot CPI might actually be big enough of the catalyst to cause the market to maybe start to front run some of that seasonal weakness, and that obviously was completely wrong. So today, for the first time in a while, I did lose money on shorting the TQQQ. I am keeping a bit of a position in that, which could be a mistake because I'm still front running this, and I kind of agree with what Brant said in the VTF earlier, that if they couldn't sell the market today off of the CPI, what makes us think that they're going to sell the market tomorrow or Friday when there isn't necessarily a catalyst for that? Now, maybe there still can be a catalyst for that. We've got PPI tomorrow, but PPI, like Pat said, tends to not influence CPI, tends to not give as big of a movement as CPI does. But I feel like we have seen in the past, when you get a hot CPI followed by a hot PPI, that the cumulative effect of both actually begins to impact the market a little bit. And we did just see headlines coming out of the Trump administration saying that he is probably maybe going to announce retaliatory tariffs either later today or tomorrow morning. That could also act as a potential catalyst, provided that he actually follows through with it this time and isn't just using this as a negotiating tool like he did with Canada and Mexico. Though I guess those are still on the table for a month out from now, or a little bit less than a month out from now. So, the bottom line is the underlying bid in this market is mind blowing. The technicals are the most important thing. I thought that maybe we could have it today. I wanted to push the short, not immediately off the open because we don't chase extension, but like I loved this short here. I really, really loved this short here. And it gave enough of a move that hopefully, unless you're super, super greedy, you're able to book some profit for yourself into that move, and then you manage your risk on the trade so that you didn't hurt yourself and you made some money and got out of the way, but didn't get any of the downside follow through that I thought we might get by losing some of these key technical levels. SPYs were below 600 at a certain point today, which is the spot where I think this market goes from neutral bullish to neutral. The Qs were, I guess the Qs were never really in too much danger, but they were trying to work their way maybe to get through 520 at a certain point today if we could go down. And the IWM had lost that 226 yesterday, and I didn't think it was out of the cards that they could test the 218 level today, and that obviously didn't happen. We didn't get anywhere close to that. And some of these strengths in some individual stocks also still is really incredible. But I also still circle back to what I was saying in the morning meeting about how there's been this dispersion effect that's still ongoing, right? These SPYs and these Qs are just super, super tight here. They can't break out. They can't break down. Yet most of Mag 7, not all of Mag 7, Apple's improving because of the Alibaba news. Meta's still a decent looking chart overall, but Microsoft doesn't look good. Google doesn't look good. Amazon looks not great, to be honest. And I'm just seeing now Amazon closed on lows. I don't know what happened in Amazon the last hour of the day today. These are the biggest market cap stocks in the world, and for the most part, they're not performing well, which means that you have to be getting a rotation into something else in order for these Qs and these SPYs to stay flatlined. And that's what's happening. The question is, if we get into this period of seasonal weakness and these other names stay weak, do they then begin to break down everything else as well? And that's kind of what I'm looking for. So we'll see if that plays out. But the bottom line is, we can talk about data, and we can talk about fundamental thesis that makes logical sense. But the bottom line is that the technicals and price are what pay. So you got to be careful if you are, just trying to blindly short this market, because it's not impossible for us to actually get above all-time highs, get above 610, and then give an incredible continuation from there. So that is pretty much all that I've got on my end. I am happy to answer any questions. Just want to see the commentary from Bill here, because I think it's in line with what I was just talking about. I saw some talk about the number being hot from January resets. And then from February onwards, we'll resume disinflation. Argument using rent of shelter progressing in the right direction. I don't know, but food for thought. Yeah, I saw that also. And I mean, that actually almost goes back to the opposite idea, which almost seems counter to what we saw today on the CPI number of a potential growth scare that could come into the market as the government, lays everybody off. And, while I'm all for making the government smaller and more efficient, there could be growth repercussions of money not going out in the same way that it had previously, broadly speaking. But I don't think that we see that take place tomorrow. I think that is a multi-month process before it begins to show in the numbers, which flies in the face a little bit of a hotter CPI today, and potentially almost even balances it out a little bit, which could be a bold thesis, to be honest. What else? Varun is asking me about Bros. I didn't see the numbers on Bros. I don't know if anybody can post them for Varun. But Bros is trading up on its earnings report. Starbucks continues to look great ever since its earnings report. This is a great looking pattern, great continuation off the ADMA today, setting up for a bull flag breakout. Broke through 112.50 today to give that continuation. So Starbucks looks great on the road to recovery. Starbucks got a mention in that podcast that I recommended that people check out the other day with Aswath Damadorian, or however you say his last name, which if you're involved in Starbucks, you might want to have a listen on. But overall, the technicals look great. From Dave S., question about some terminology used in the morning meeting. What specifically is a distribution pattern, and what is someone supposed to do when something as key as the SPY is currently in one? My assumption is that if it's a specific stock, you just avoid it due to being very hard to tell when it's truly breaking out of that pattern while it's happening. The whole market is doing this currently per earlier today. So it's hard to stay away, since most of my trading involves either trading the SPY or using it as a factor either for or against the trade in my decision-making process. Sure. So very broadly speaking, markets are typically defined into like 4 periods, which is like an accumulation phase, an uptrend or buying phase, a distribution phase, and then like a sell-off phase. Like that's supposedly the 4 parts of a market cycle. The up part and the down part, right? The breakout, the buying part, that manifests itself in an uptrend. The sell-off part after the distribution phase, that manifests itself into a downtrend. And as traders, we generally prefer markets that trend. They give us better advantage, better risk-reward opportunities, higher probability of success on trades you're taking when you're taking them in the direction of the trend when trend is actually ongoing. The accumulation phase and the distribution phase are sideways markets. They're range-bound markets. They're trend-less markets. I've experienced in my career, entire trading years of sideways price action. That can happen, very, very big picture. So basically, what they say is the accumulation phase is when the smart money buys from the dumb money. They start accumulating there. So you have like a downtrend of selling leading to selling leading to selling, and then eventually the market reaches a point where it's discounted enough that smart buyers are willing to come in and buy that, and the dumb sellers are continuing to panic and puke out stock, but they start to weigh each other out, and that's why the market goes sideways. It's like a base, and then that base breaks out eventually when the weak or dumb money sellers run out of selling, and then eventually everyone starts buying again, and you go into the uptrend. The distribution phase is the opposite. That's the period of time where smart money sells to dumb money that's in like a. You can also look at like the chart of like trader emotion or investor emotion or whatever, where sentiment is really 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 high, but it's like in a euphoric stage that becomes unsustainable, and the smart money says, whoa, this market is really expensive and we don't like it in the same way, and we don't like the risks that are on the horizon, and smart money sells while the dumb money continues to buy. Now, also traditionally, the dumb money was considered to be retail money, and the smart money was considered to be like fund money. And Tate had a follow-up question: what is the definition of retail? Well, retail is the aggregate of basically retail brokerage accounts. To some degree, retirement accounts, 401ks, IRAs, but also just regular retail brokerage accounts. It's the Robinhoods of the world. It is the Schwabs of the world. It's those. Now, I would actually make an argument that retail money has gotten smarter over time. I actually do think that's true. I think that the average retail investor is probably more educated in 2025 on average. Obviously, there's a lot of idiots out there. I would say on average that the typical retail investor or trader is smarter in 2025 than they were in the 1990s or whatever. They just know more. There's more education out there. People understand now the concept of trying to buy a pullback in the market, trying to buy dips in the market, like that. That's when you want to come in. But it's interesting to see a couple of statistics that we've seen as this market is potentially in a technical look. I mean, we've been in a range now basically since November, right? We've been more or less going sideways. We had a little bit of a pullback. I don't remember what the percentage was, maybe a 5% pullback or something like that in the December-January dip. But really, we've been more or less ranging between, like, I don't know, this SPY low 580s and this SPY like 608 to 610 really since November. So at the same time as we're seeing that, we're seeing all these statistics that retail is buying more than they've ever bought before. They're buying more than they bought in 2020 in COVID. They bought more. They're buying more now than they bought during the GameStop phase, the meme phase. We've also seen, per Pat's note, I don't remember which bank it came from, that whatever their retail sentiment gauge is like maxed out. It's higher than it's higher than it was also in those periods of time. Well, that to me that sounds like distribution of euphoric retail buyers who are going nutty on Wall Street bets and going nutty with cryptocurrency and going nutty YOLOing call options in a market that actually can't break out to new all-time highs. I think I'd be having a different thought process and a different conversation if I wasn't looking at a consolidating market. if I was looking at a market that had already broken out, I probably wouldn't be thinking as bearish as I actually am in conjunction with this data. And that is all happening. This huge retail buying and retail sentiment is happening right prior to us going into a period of seasonal weakness that could trigger right as retail is running out of bullets because of the buying of 1 to 3% dips in a massive way over the course of 3 weeks. You got those statistics that the retail buy imbalance has been bigger on a handful of trading days this year than almost any other point in history. So to me, that smells very much of a distribution period of this market. Now, with all that said, I have always found it interesting and sometimes difficult that distribution, so think about what a bull flag actually is, right? You have a market that moves higher. It runs into an area of increased supply. That then causes the market to go sideways. There maintains a strong underlying demand. And then eventually the overhead supply runs out. The underlying demand stays there. And then you get a breakout and you get continuation. I've always found it difficult technically to identify whether what I'm looking at is technically distribution because it's an upper level consolidation, or it is actually more like a bear flag pattern where the market's up a lot, it runs into some overhead supply, there's strong underlying demand, the supply gets eaten away slowly by that strong underlying demand, and then once that overhead supply is gone, then you actually get your next leg up. And I can't, looking at this chart right now of the SPYs, tell you if this is a big picture multi-month bull flag that's digesting a huge uptrend before continuation, or if this is a topping process that eventually leads to some sort of a round lower in the market. I can't tell you that looking at this pattern. The reason why I am leaning towards thinking that it's distribution and not a bull flag is because of all of the data that we just discussed. The retail data, the seasonality data, the fact that if you look at the CTA numbers are becoming skewed to the downside at this point, where in a flat tape and an up tape there still is CTA buying, but it's very small compared to the amount of selling that can actually come in a down tape now. So they're starting to get maxed out. I saw some other data that a lot of hedge funds are also sitting at their 95th percentile in terms of long exposure. So that to me is an additional risk to the downside. The vol control looks to me like it still actually could buy more, but interestingly enough, the last 2 days of data that Bill has shown us has shown that there has been no buying even in a flat tape from vol control, that risk is actually also to the downside. But I would also hearken when it comes to understanding this flow data that you still actually need a trigger, and you need that trigger to come in at the right time. I remember back in 2024 that a lot of the buying data also showed by the end of February that they were maxed out and the risk was to the downside, but the uptrend continued for over a month before we actually got the technical pullback to wash out those longs. So that data is something to note because it starts to skew more towards the downside in a sell-off than what is there in a flat market or an up market. But you still actually need a trigger. And then the final thing I would say about that is I would go back to the beginning of 2020 as went into COVID. I was just in 2020 beginning to learn a lot of this stuff. And big shout out to Pat, because Pat was the one that first in 2018 or 2019 was like, hey, you should really take a look at some of this gamma data. I don't fully understand it. I'm learning it too, but it's interesting on how this works, where when we're in this like positive gamma environment, that the markets tend to be more range bound because buying is met with selling and selling is met with buying. And if we go into it's like that was the beginning of it. So huge shout out to Pat, and then you know, for initially triggering the curiosity and showing me that it works, and then also huge shout out to Bill Kay for helping to provide me the information. I feel like that kind of took my knowledge in a lot of ways to the next level on it. But in 2020, I didn't know everything I knew now, but I know a lot of people who live in China, and a bunch of people who are actually pretty well connected to the government in China, and they were telling me about COVID in December of 2019, and I remember prior to there being a single case of COVID in the United States, just strictly based off of what they were telling me they were experiencing in China. This is still when I taught martial arts all day, every day on Saturday in New York before my whole life changed because of COVID. I remember doing a martial arts class on a Saturday, either at the very end of December or beginning of January, before there was a single case in the United States, and telling people, hey, I've heard about this weird virus that's ongoing in China, and if it made it here, it could be a really, really big deal. It looks like a lot of people are dying and are really sick over there, and it could be a big problem. And I remember getting on the train, Long Island Railroad, and researching what an N95 mask was, and going and buying some before there was a single case of COVID, and recommending to friends and doing it myself, going out and buying a bunch of canned food and having it stocked away in my apartment. The one thing I didn't buy, and I'll remember this for next time there's an end of the world situation, was a ton of toilet paper. But luckily I ended up being okay in that front also. But from a trading perspective, as I remember given like a morning or afternoon meeting before there was a single case of this in the United States, and saying, just imagine what could happen if just one case of this insanely infectious disease that seems like it's very deadly shows up in the United States. Like, we need to be prepared for this. And then I believe it was in January of 2020 that one case showed up. And I was like, oh my God, I'm starting to short. I'm shorting the world. I remember, I'll never forget, I was getting smoked shorting TCOM, which is a Chinese travel company. It's a Chinese travel company that couldn't even actually operate because they're in China and China was shut down. And this stock was going up. Yeah, here it is. This stock was going up every day. And I was shorting it, and I didn't have a stop loss, and I was getting my face ripped off. In this move right here. Look at this move in the beginning of January. You literally couldn't travel in that country of China. Everything was shut down by that point. And this stock was continuing to move higher every single day, from a move from $35 up to $39. And I wasn't just short this, I was short other things as well. And you know, we can look at the market back at that period of time also. Eventually we got this little dip here at the very end of January. Guess when that was? Right after January OPEX. And then the market went and made new all-time highs again. And I was like, I guess I'm wrong. I thought that this was going to be a big deal, but the pullback came and we just dropped a little bit in the SPYs, and now we're making new all-time highs. I was short so much stuff, and I lost money short. I lost money short COVID before anybody was like shorting this. You know, I was too early, and I remember I was going nuts. I was going completely crazy. I actually went to Lake Tahoe for like a vacation for like a week, but I was trading every morning, and I had all these shorts on, and I was getting smoked in TCOM and getting smoked in the market. And I covered all my shorts I probably covered all my shorts for a loss somewhere around like February 14th or so. And I was so frustrated by it. And I had some longs on, and then guess what happened? February, Bill just gave us the date. February 21st was February OPEX. Hey, where are we right now? What are we approaching? We're approaching February OPEX. Ooh, interesting. February 21st was Feb OPEX. And that was the day when Feb OPEX happened that the market dynamics changed in such a way that the market was allowed to realize the downside of COVID. Nothing new from an information perspective happened on February 24th versus February 19th or February 20th. Nothing new happened. All the information was there, but the market was then finally allowed to move from a dynamics perspective once OPEX actually hit, and the catalyst of COVID was still there at that time. And then, boom, look what happened. And for me, it was one of the biggest lessons of my entire trading career that has shaped who I am as a trader now 5 years later, which is, so I actually ended up doing really, really well for myself. I caught the bottom like perfectly on March 23rd. I remember being at that point in upstate New York, and I bought a boatload of stock. But I got destroyed in the beginning of 2020 because I didn't know what I know now about market dynamics. All I knew was technical analysis, and technical analysis is great, and I still think it's the most important thing, but I don't actually think it gives you the full, complete picture of understanding the why in the same way that I used to prior to this event happening. Because what happened to me was I was short the market in expectation of COVID, and I lost a good amount of money shorting. And then I liquidated those shorts. I said, look, I was wrong. Look, the market's bull flagging. Look at this bullish pattern. Market is bull flagging here. I got to get out of the shorts. I got to get back long the market. And when Feb OPEX actually hit, I didn't have any shorts. I only had longs. So I got smoked on my shorts. I got smoked on my longs. Eventually I had to stop myself out of all those longs. My account took a really big hit. And then luckily I had some of the best trades of my entire career off the bottom in March of 2020, where I was able to, basically make everything back and get myself out of the hole that I had dug myself into in the beginning of the year from just being backwards on it. But it was all about understanding these market dynamics. So now, look, we're not, I don't think, having like a COVID type of global lockdown situation on the horizon right now in the immediate time frame. But if we now circle back to the current day, and you look at the data again that we're discussing about the retail buying, the retail sentiment, the positioning information that we have, in conjunction with, if anyone remembers, back in mid-January, I was saying the main risks that could really create a bigger market sell-off are Mag 7 earnings disappointing, especially because they're spending too much money. Well, guess what? We just got through almost all of Mag 7. We know what those charts look like. They don't look good. But yet the market has still been able to hold up because the market dynamic impact is creating dispersion right now and not letting the market actually sell. So you're getting outperformance from QQQE over QQQ, which is something that's completely different than what we've seen over the course of the last couple of years. But I think that we've got the catalyst now of Mag 7 potentially setting up to sell off, which is always difficult because their buybacks are so big. But it doesn't look to me like the CapEx that they're doing is justifying the revenue, especially as the story begins to change from DeepSeek. And you combine that with the interest rate story, which was one of the other major catalysts that I was looking at. Another incredible that the market has held up today as well as it did and closed the gap as well as it did. I know the IWM was weak given the move higher on interest rates today and the impact that should have on the market. Why can nothing break this market? How is it possible that you get 3 scares in a row that just lead to 1 to 3% corrections that immediately get bought right back up? Well, it's because of these market dynamics, and those market dynamics are about to change. However, similar to the fact that COVID was leading to a global shutdown in 2020 in conjunction with the February 21st, 2020 OPEX date, you still had the catalyst. So we still will need a catalyst to actually hit, I think, when that time kind of comes around again this month. But I really think that once we get into late February, you will not get a situation where there's a scare that gets bought up immediately. I think that if you get a scare, that actually turns into a big red bar right as all the market participants got used to, oh, here we are, 2% dip, I get to buy and get rich. And then that actually leads to a significantly larger sell off. So, I kind of want to, I don't even remember what caused all that. I think that was all related from Dave S's question. So I hope that helped answer your question there. But there's some really good stuff that I think was kind of worth going over. And I guess the bottom line to answer your question is that when you are in that consolidation, you take a less is more approach, and you be patient and you wait till you have the stronger advantage. That's the big thing that I keep saying is like, don't be too early right now and pull your hair out, even though I've been a little bit too early myself. Try not to be too early. And it's still not impossible, even though I just described my thesis, it's not impossible for this to actually just be a bull flag that breaks out to all-time highs that gives us continuation. Because a reduction in gamma post-OPEX goes both directions. And if it's possible, I don't know what, there could be an upside catalyst that comes in as well. I don't know what that is. Maybe Trump announces that he's getting rid of all corporate taxes or something. They're going to 0%. I'm using an extreme nonsensical example, but just to get you the point across. That becomes a catalyst that causes the breakout above 610 that then turns us into a bull flag that gives us continuation after OPEX that leads to maybe we end up getting ball up, spot up type situation at a certain point. That's not what I'm expecting, but as traders, as risk managers, I should say, we need to be prepared for all situations. So yeah, I hope that helps. That took a bunch of time. I have a lot of Feb, OPEX, SPX put, and Feb VIX call positioning that will be expiring on 219 and 221. And I imagine I'm not the only one. Yeah. Cool. Over on the YouTube, Apex Joy wants to know if I think TEM can go higher. Sure. It doesn't look that extended. I mean, this has been on news catalysts on the way up, so I don't see why that can't continue. Why don't you use extended hours on your charts? I use extended hours on my charts in the pre-market and in the post-market. I don't use it during the day, and the main reason for that is because I think it skews the technicals because there's not enough volume pre-market and post-market. Pre-market I look at it because it's all you got, but I mean look at I mean this is a day when we had CPI today too, so there's a little bit more volume pre-market than there typically is. But look at like yesterday as an example. Look at the pre-market volume prior to 9:30 versus the post 9:30 volume. So I think that so I change my charts to only in market hours, only at 9:30, like at 9:28 basically every day as soon as I finish the morning meeting, to only look at that price action because I think that the pre-market incorrectly skews the price action and the moving averages based on data that was so much lower volume that it doesn't matter. And especially if you look at, I don't know, I'm trying to think of a stock that does like 0 pre-market volume or like 100 shares go off. But yeah, like if you look at, I just typed up VAL, no pre-market volume going off at all. Like this is just ugly and sloppy and confuses the charts and makes them not look clean and clear. From Formula One, such a tricky market. I feel whenever I have an intraday thesis on what should happen after some form of catalyst. The market is intentionally reversing the complete opposite way, as if it's on purpose. Is that a bad way to think about things? I think it's a bad way to think about things. Yeah. It's not reversing it on purpose to make you pull your hair out and go bald. It's just a matter of the things that we just discussed. It's because that seemed like a catalyst to me too. It cost me some money today because I was trying to be aggressive shorting. But there is a reason for why the market got blown up the way that it did. I think we just discussed it in detail. And I don't like the idea of traders getting in their head, like, I don't want to say conspiracy theories, but like, that idea of like, oh, they know where my stop is and they went after my stop. Like, they don't know your stop. They don't care about your stop. But it is very often that the market can frustrate you and frustrate everyone. Like, that's almost like a mechanism of the market sometimes. From Scott, I'm bearish. Buys and Qs have pushed high enough. Be careful with that line, with that terminology. I see weakness in the near term, so I'm looking for a big pullback. Also, with this inflation report, the consumer has got to be ready to bust. Yeah, we'll see. From Giancarlo, would you look to reshort Tesla around the retracement back to the 80-minute on the daily chart? Yeah, so I like Tesla short. Today in the morning meeting, I didn't take it, but I actually called out for a long, just an extension bounce trade. I like the idea of looking to short bounces in Tesla. It's the weakest and worst one that's out there. I think you could look at the 80MA. If it overshoots that 80MA because the market's being strong, I think you could look at a retest of the support that broke down at around 375. So I like the 375 area. It'll be in conjunction with the 21 EMA. I also broadly like looking for any sort of short signal to come in on a bounce back to space between the 8 and 21 EMA. Yeah, Formula One. Just reading the second part of your comment, I just think it's about understanding timing and understand like that. That's part of trading to some degree. So the follow up comment was, and of course when the trade turns not in your favor, there is usually no continuation, and your original plan ends up playing out, but only once you're fully stopped out. There's definitely truth to your statement. I think we've all been there. The market can kind of twist us around sometimes. So that's why it's just so important to understand execution and timing and risk management. If you're trying to take size in your executions, then you got to stop yourself out quickly. But you're recognizing that you're stopping yourself out quickly. And if you still have the thesis and the trade is still there, then you can reshort when the execution is actually there. Or a bit more of what I do, which occasionally gets me into a little bit of trouble, is I start smaller and I build in, so that when other people are getting frustrated and getting shaken out, I'm actually at the point where I'm reaching like a maximum sizing on the position, and then the trade works. So I think it's a combination of timing and sizing and risk management that can oftentimes be the difference from an execution perspective of a trader of a trader getting stopped out of an idea that works versus a trader making a lot of money on those ideas that work. From Robert, one of the best exercise to learn market dynamics is to listen to your meetings and implement that mentality. What else would you recommend to get more knowledge about market dynamics if we want to get improved by ourselves? It's a little bit tricky because you got to be able to get your hands on the data and the information, which it's hard to be able to do that for free. So you kind of have to pay for resources that can give you that information. And then honestly, a lot of what I've done, a lot of what I still do, a lot of times I read things that I don't understand, especially when it's coming from Charlie McElligott at Nomura. I read a lot of those research reports in conjunction with AI. I usually use Perplexity, not ChatGPT. And I'll be like asking Perplexity, like, hey, I'll literally like copy and paste part of the note sometimes into AI, and ask the AI to translate it for me. I'm like, can you tell me a little bit about what you think he means when he says, this following sentence, and then I kind of copy and paste that sentence. So, you got to get yourself on the research, on the data, and it's not necessarily easy because you need a good resource for that. You probably have to pay for it. But, Pat's Morning Note is a great resource for that. So if you have access to the virtual trading floor, that is your way to be able to get the market dynamic information that comes from Pat's note to then be able to implement it into your trading in more real time, as opposed to my afternoon meetings, which are oftentimes a little bit more after the fact. So pre-market is mostly randomness other than data reporting days. It's not necessarily randomness. It's just not enough volume for it to matter. It is the way that I would describe that. And even on a day like today where we have CPI, I switch over to just 9:30 to 4 as soon as the market opens. But I mark down mentally the important pre-market prices from when there was volume because of the news event. Like, I want to know what price this 8:30 a.m. high is. I want to know the pre-market low of the day. I don't need to have my chart up to see it. I just mentally make note of it. And every once in a while, if I forget the number, I'm only looking at this chart during the day. That's the actual market hours. But then I will, I'll sometimes just quick go back to this chart to reference it, and then I'll go back to during the day. Bill K recommending also checking out Jem Carson, who also talks about a lot of this stuff, and he's always putting out free stuff. Also, he's always putting out podcasts all the time where he's talking about this stuff. So he's a great resource that I've also utilized to learn a lot from. Do you have any particular indicators you use daily besides EMAs? No, not really. My charting is very simple. Japanese candlesticks, volume, a couple moving averages that are really important to me. I'm not against necessarily other indicators. I just think that we want to recognize that indicators are not the end-all be-all. They are literally what they say they are. Indicators indicate something. So it's an additional piece of information, and that can be beneficial. So even though I don't use them, I pay attention to them when other traders on my team provide them. Like Pat in his morning note every day, he uses Ichimoto clouds and Bollinger Bands. I don't use those, but when I'm looking at Pat's morning note every day, I make note of the information that he's providing to me. Or one that I like as well is RSI. I don't put RSI on my charts, but when people on my team are providing RSI for a particular stock or whatever on a particular time frame, especially if it's something I'm trading, I certainly make sure to pay attention to it because that extra information can be beneficial. I use an 8 and 21 EMA on almost every chart. I also don't necessarily always use, but I like on daily charts 20, 50, and 200 SMAs, just to show trend, directionality. All right, I'm starting to lose my voice again, so I'm going to end the meeting there. Looks like I got through all the questions. This is a really good meeting. Have a great night, everybody. I will see you all tomorrow.